$520,000 a day. That is what it costs this week to charter a supertanker out of the Gulf to China. That is within about $7,000 of the highest rate ever recorded on that route. One cargo fixed this week at roughly $31 million for a single voyage. 5.34%. That is where the 30-year U.S. Treasury yield went on Tuesday. The highest since 2007, a 19-year high. And here's a third number that almost nobody reported. Japan's oil import bill last month rose 88% against a year ago. The volume of crude Japan actually bought rose 5.5%. So none of those three was the news this week. The news was relief. Washington paused its 50% tariff on Canadian goods hours before it was due to bite. The bond market calmed after the Treasury stepped in. The market's fear gauge sat near a low for the year, even as a war deadline expires with nothing signed. And the relief is real. The system did absorb the shock, but the bill still got paid. It just got paid somewhere almost nobody was looking. That is what I want to show you today. Here's the thesis in one sentence. This week, the war and the trade fight stopped repricing and started repricing plumbing. The cost of capital, the cost of movement, the cost of compliance. And plumbing does not unwind on an announcement. Let me walk you through the week. Start with Canada. A 50% duty on roughly $20 billion of Canadian goods was due Wednesday. On Tuesday evening, hours before it landed, the president signed a temporary suspension and announced a deal. Ottawa did not announce a deal. The prime minister's own statement confirms a postponement and nothing else. Substantial progress has been made, although there is important work still to be done. So look at what actually exists in law. Proclamations imposing the duties, and one proclamation delaying them until 1 minute past midnight tonight. That is a date change. There's no published agreement. Not from Ottawa, not from Washington, not in the Federal Register, not in the Canadian Gazette. Canada's trade minister spent 3 hours with the U.S. trade representative on Thursday and said this morning that the two sides are very close. And by Thursday, the prime minister was asking the provinces to put American alcohol back on the shelves as a gesture of good faith. That is a government spending domestic political capital to buy an extension, which tells you the text does not exist yet. Now, Hormuz. The 60-day negotiating window between Washington and Tehran expired Monday with nothing agreed. Everyone is very surprised. Transits collapsed over the weekend into single digits. And on Tuesday, a projectile struck a bulk carrier in transit and killed a seafarer. That ended the argument that only state carrier tankers were targets. Every hull in that water now carries war risk. Traffic has since recovered off the floor, but look at how. On Wednesday, more ships crossed the strait with their transponders off than with them on. First time. Dark tonnage is now the majority of that waterway. And the buyers moved. Chinese refiners bought 8 million barrels of Iraqi crude for prompt delivery. 2 Chinese supertankers turned around inside the strait. Jebel Ali is running at roughly a tenth of its normal container throughput. And Japan's import bill did what I told you at the top, up 88% on 5.5% more barrels. Meanwhile, Washington opened a second front. Since late July, it has been designating the counterparties rather than the country, ship registries, marine insurers, exchange houses in Dubai and Hong Kong and Singapore, front companies, and this week, individuals in Turkey. Yesterday, the president widened the threat to any country whose banks, airports, or government entities assist Tehran. And this morning, the Treasury Secretary went further. The toughest sanctions in history, aimed at collapsing the Iranian government, with an explicit request that China join. Beijing said no in public within hours. Tehran's answer is the tell. Iran's foreign minister is not appealing to capitals. He is warning that this threatens the global economy and sovereignty worldwide. That is an argument aimed at central banks and payment systems. It tells you where Iran expects to find cover. Then the long end on the bond market. The 30-year touched 5.34 on Tuesday. Canadian long yields hit their highest since 2010. French 30-year yields, their highest since 2008. German 10 years, their highest since 2011. And on Wednesday, the U.S. Treasury announced it would at least double the size of its long-end buybacks, from a $2 billion maximum to a $4 billion minimum, starting the 9th of September and running only to the 4th of November. The 30-year fell back to 5.19. It closed Thursday at 5.23, and it is trading around 5.24 as I record this. The dollar sank to a 3-month low. Same day, the July Federal Reserve minutes landed. The committee held at 3.5 to 3.75 on a 9-3 vote. Logan, Hammack, and Kashgari dissented in favor of a quarter-point hike. Several other participants said they favored one, and in the same 48 hours, the U.S. national debt crossed $40 trillion for the first time. That's double since 2017. One more item, and it matters more than its coverage suggests. This week's joint military exercise with South Korea was cut from 10 days to 4. It ends today. The president ordered it by social media post and gave his reasons: his relationship with Kim Jong-un, the cost, and the fact that he asked Seoul for help in the Iran operation, and Seoul said no, thank you. Well, Seoul learned about it from the Post. Separately, the carrier that covered the Western Pacific is now in the Middle East, and there is currently no American carrier strike group west of San Diego. So, the consensus read on all of that is resilience. Tariff paused, volatility low, long yields off their highs. That read is not wrong, it is incomplete. The system does have absorptive capacity. What it does not have is a mechanism for giving back what it just paid. Look at where the cost actually landed. Freight repriced because vessels, crews, and war risk cover are the scarce inputs, not barrels. Charter rates on that route are within a rounding error of an all-time record, while crude is still in the 90s. If your model watches Brent, it missed almost all of that. Japan's bill is the proof. The barrels barely moved. The invoice nearly doubled. And here is the part that matters most. Rerouting is extensive to do once and cheap to keep doing. Chinese refiners did not wait for the strait to normalize. They bought Iraqi. Every contract signed around Hormuz this month is a contract with no particular reason to come back when Hormuz reopens. Capital repriced for a completely different reason: deficits, issuance, and foreign selling. Not the policy rate. The Fed is holding, with a hawkish minority pressing to go higher. The 30-year is at 19-year highs regardless. Two different prices set by two different mechanisms, and only one of them is under anyone's control. And the buyback expansion is a liquidity operation, not a fiscal correction. It bought about 10 basis points on a calmer tape, and it is scheduled to stop in November. It did not retire a single dollar of the underlying issuance. The debt went through $40 trillion in the same week. Compliance repriced because the target set moved from Iran to everyone who touches Iran. If you have Gulf, Turkish, or Asian payment and freight exposure, you now carry a screening obligation you did not carry in July. On counterparties, on routing, on payment rails. And compliance perimeters widen. They do not narrow when a war ends. 3 prices, none of them announced. None of them reversible by press conference. And meanwhile, the 2 things that were announced, a Canadian deal with no text and control of Hormuz that the vessel counts flatly contradict, changed nothing a business can actually bank. So what do you do with that? If you are deploying capital, stop running 2 discount rates. A lot of plans built after 2021 still carry a financing assumption anchored to the policy rate, on the theory that the long end eventually follows the Fed down. It has not, and this week's minutes remove the last argument that it will soon. Rerun every capital project, every refinancing, every valuation at the long end level, not the target rate level. Treat this week's small rally as a window to issue, not a signal to relever. And when the long end reprices globally, the cost of capital rises for every borrower, regardless of credit quality or jurisdiction. There is nowhere to arbitrage to. If you are running operations, your landed cost model probably watches Brent. Brent is now the least informative line in it. Rebuild it around the charter rate and the war risk premium. Then screen your counterparty book for Iran adjacent exposure, banks, freight forwarders, exchange houses, ship registries. This week, not next quarter. The perimeter widened twice in the last 7 days. And if you are Canadian, there are 2 moves, and they point the same way. The defensive one is straightforward. The duties are scheduled to land at 1 minute past midnight tonight. Price your fourth quarter landed cost as though they do. Keep tariff-inclusive contract language in place. Treat any relief as upside, not as baseline. A 3-day delay attached to an unpublished deal is a scheduling change, not a settlement. The offensive one is bigger, and almost nobody is pricing it. Yesterday, a South Korean container ship sailed out of Busan bound for Northern Europe, over the top of Russia. I want to be precise. That voyage was planned before this war. It is a Korean Arctic strategy, not a Hormuz workaround. But it sails in the same month 2 of the world's choke points became unreliable. And that is the point. Route reliability is being repriced everywhere at once. If Hormuz and the Red Sea stay unreliable, then Arctic governance, ice class capacity, and northern port and rail infrastructure move from a 2040s file to a live commercial question, with real sanctions complications attached, because that route needs Russian permits. Canada owns the other side of that geography. That is a positioning decision, not a shipping story, and it gets made in the next 18 months, whether or not Ottawa participates. We have watched governments manage under this kind of compound pressure before. I served in Canada's Prime Minister's office during the 2008 financial crisis, and as a Chief of Staff in the Senate during the 2020 pandemic. What our team took from both is this. The announceable variable and the governing variable are rarely the same one, and institutions under strain reach for the announceable one first, because it is the only lever that moves inside a news cycle. That is not cynicism about the people involved. It is the description of the incentive. Your job is to know which lever is which and to build on the one that is still there on Monday. Which brings me back to Seoul. An ally learning about a change to its own defense posture from a social media post is a preview. Any plan you have that assumes allied predictability in supply chains, in market access, and security now needs a stated fallback and a named owner. Write both down this week. So, for things to do, rerun the capital plan at the long end rate. Rebuild landed cost around freight and insurance, not the crude print. Screen the counterparty book for third-party Iran exposure. And hold your tariff-inclusive Canadian pricing through the weekend, whatever happens at midnight tonight. And 4 gauges to watch. First, whether a Canada-US text is actually published, or whether the weekend produces another extension. Second, whether supertanker rates hold above $400,000 a day once the immediate scarcity eases. That tells you whether the rerouting is structural or panic. Third, whether the 30-year settles back above 5.3% after the buyback effect fades in November, which would confirm the intervention bought calm rather than a trend. And fourth, whether a second Gulf state follows the Emirates in cutting commercial ties with Tehran. 4 days on, none has. That is the gauge that moves this from a shipping problem into a payments problem. The headline this week was relief. The bill was paid in the plumbing, in the discount rate. the charter rate, and the compliance perimeter. And none of those three lines has a mechanism for going back. If you want those four gauges tracked daily rather than weekly, the corridor brief goes out every morning. 30 items ranked by decision impact, and it's free. I am Joseph Soares. Build for the line that does not make the front page.